Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing VICI property stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. VICI Properties is a REIT specializing in casino properties. The company is headquartered in New York City and was founded in 2017. It started trading in 2017 and can be found on the New York Stock Exchange and Deutsche Börse. It was formed as part of the Chapter 11 bankruptcy reorganization of Caesars Entertainment. After filing bankruptcy in January 2015, Caesars proposed splitting into two companies, a REIT, which would own the company's casinos, and an operating company, which would manage them. The plan was designed to maximize value for Caesars creditors by taking advantage of favorable tax treatment for REITs. The spin-off of VICI was completed on October 6, 2017, the day that Caesars emerged from bankruptcy. It has 28 properties in 17 markets with 48 million square feet, 2.2 million square feet of casino space, and 25,000 hotel rooms. It has collected 100% of its rent, unlike its competitors that collected between 2% and 68% of their rent. AFFO, adjusted funds from operations, is an important stat when looking at a REIT. Their AFFO per share has improved from $1.43 in 2018 to $1.82 this year. The name of the company comes from the phrase Veni Vidi Vici, which means I came, I saw, I conquered. It is a Latin phrase attributed to Julius Caesar. Its average rental agreement is 34 years, which is much longer than any of its competitors. This should give you comfort that there will be low turnover on its properties. Also, its AFFO has grown a lot more than others. Lots of REITs have negative AFFO due to the difficult times of COVID. This company has actually improved during COVID. Can you just imagine how well they will do this year and next year, now that things are almost completely opened up? VICI is constantly adding to its portfolio. Just a few months ago in March, it announced the acquisition of the Venetian in Las Vegas. The Venetian is the single largest hotel complex in America. It is also one of the largest casinos in Vegas. A REIT is only as good as its tenants. This company has some of the best in the industry. It has partnered with Caesars, Penn National Gaming, Hard Rock, Century Casinos, Jack Entertainment, and Chelsea Piers. Lots of well-established, reputable brands. Its portfolio is not only in Vegas. Less than half of its properties are in Vegas. In the event Las Vegas struggles attracting tourists, this company will have money coming in from other parts of the US. Here is a visual of the cap rates for each property. The cap rate is a total return on a real estate investment. The big properties are Bellagio and the Venetian. Both of these have a cap rate of 6%. The higher the cap rate, the higher the return. But if the cap rate is over 7%, the investment may be a bit risky. Below 4% is not worth investing in due to the low returns. The sweet spot for cap rates is 4% to 7%. Some investors feel the higher the institutional ownership, the better, since institutions can buy lots of stock at a time, which may drive up the stock price. Also, institutions have teams of analysts that research stocks before the company invests in them. It is considered smart money. Another thing is that small investors like us like to have their interests align with a multi-billion-dollar institution. VICI's institutional ownership has grown from 22% to 66%. In 2018, MGM Growth Properties offered to acquire VICI for $6 billion, but VICI's board rejected the offer. Currently, VICI's market cap is $17 billion, so that was a good decision to reject MGM's offer. Let's get started with the model. This is a large cap company, 17 billion market cap. They're trading at $31 a share, and they have 553 million shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So you can see their free cash flow grows a lot, from $500 million to $900 million. Net income is the profit or loss on the income statement. It's revenue minus expenses. That also grows a ton, from $500 million to $1.2 billion. Revenue is the sales for the company, and that peaked in the trailing 12 months. All their numbers peaked in the trailing 12 months. So this company has prospered during COVID. This is the company's income statement. The top line is the revenue, the sales. Below that is the cost of revenue. These are the expenses directly related to generating the revenue. REITs usually have low cost of revenue because they're not making products, they don't have a factory, they don't have expensive machinery, they just have to collect rent payments. Revenue minus cost of revenue gives you your gross profit. That peaked in the trailing 12 months. Then below that is operating expenses. And they do have a lot of operating expenses in 2020 and the trailing 12 months. Most of their operating expenses are credit losses that they pass through onto the income statement. Allowance for credit losses is the money you expect not to receive from your receivables. Because if Apple sends out phones to 100 retailers, not all 100 of them are going to pay Apple. Maybe like 95 of them will, and 5 will go bankrupt or have to renegotiate the terms due to financial struggles. So they're passing through a good amount of losses in the rents they don't expect to collect, because they're not going to collect every rent payment. And I mentioned in the beginning of the video, they said in their presentation, in that chart I showed you, they collected 100% of their rent. I think they were able to say 100% because they passed through so many allowance for credit losses. Let's just say, for example, they said 10% of their rent payments wouldn't be collected. So they passed through that 10% loss before the payments were due. And then if they received at least 90% of their rent payments, it was considered receiving 100% of their payments. I can't say I'm 100% on this, but this is just my inclination. Below that is the interest they pay on their debt, and they pay $309 million of interest. That does sound like a high number, but look at their operating income. As long as they can cover their interest payments with their operating income, and they can cover it almost 4 times, then this implies the amount of interest they're paying on their debt is appropriate. And you can see they pay hardly any money in taxes. That's why companies set up REITs, so they don't have to pay taxes. Because a normal company has double taxation. Like a regular company like Apple, they would have revenue, expenses, and then they would have to pay taxes on their pre-tax income. Then whatever's left over, their profit, they can pay out as dividends, or they can buy back stock, or pay down debt, whatever they want to do with the money. Now when they pay a dividend, you as the investor get the dividend and have to pay taxes on the dividend. So the company pays taxes before it hit net income, and then you pay taxes on the dividend. So it's double taxation. REITs avoid double taxation. How can they have less than $1 million of taxes on $1.2 billion of pre-tax income? Because REITs can give the dividends out before they have to pay taxes. So they only get taxed on the money that's left over after their dividend payment. And REITs have to distribute at least 90% of taxable income out as dividends. So you can see their net income grows a lot from $500 million to $1.2 billion. It more than doubles. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. You could think of operating cash flow as net income converted to cash, because net income is your accounting profit or loss. It's not actual cash. So they generate a lot of operating cash flow, and it peaked in the trailing 12 months at over $900 million. And they don't have much money in CapEx, only a few $1,000,000 a year. You would expect them to have a lot in CapEx when they buy properties. But what they're doing is they're not buying properties, they're buying companies that own properties. So the companies that they buy are in investing cash flow. That's why their investing cash flow is so high. If they just bought properties that weren't owned by someone else, then they would put that money into CapEx. But since they're buying companies, it goes into investing cash flow. It's all the same thing, it's just how you categorize it for accounting purposes. But it is good to know. Operating cash flow minus CapEx gives you your free cash flow. And most of their free cash flow is used to pay as dividends. But the bad thing about being a REIT is that you have to pay out 90% of your income out as dividends. That means there's not much left over to grow the business. And when you invest in a company, just pretend it's your company. If you owned a company, if you owned a retail store, and the store was doing really well, you may want to open up another store, right? But if you had to give 90% of your profits back to your investors, you wouldn't have any money left over to grow the business. That's generally why we invest in companies, so they grow and their stock price gets higher. So you may be wondering, how does a REIT grow? How do they keep acquiring companies? Well, they're issuing a lot of capital stock. They IPO'd at $2 billion. They added $2 billion of stock. They added $1.1 billion in 2019 and $1.5 billion of stock in 2020. So they're diluting the shareholders. They added $2 billion of debt in 2020, and they added about $600 million of debt in 2019. So that's the only way they can grow, is issue capital stock or add debt. So it's not a bad way to grow, to add debt or add capital stock, because you can see even if they only get 10% back, 10% of 900 million is a lot higher than 10% of 500 million. Also, if they use a lot of debt to grow the business, all the interest payments on the debt come out of your investment. The interest expense on the debt is higher on the income statement, and interest payments come out of the profits before it hits the bottom of the income statement. This is the equity section of the company's balance sheet, and they raised $9.4 billion of capital stock, and they do have positive retained earnings. Retained earnings are all your profits left over after paying a dividend payment. A lot of REITs have negative retained earnings because they pay out so much in dividend payments. It is good to see that the investing community gave this company over $9 billion. So they do have a lot of money to work with. But I don't think you should be proud of being able to raise capital. It is important to raise capital, but you should be proud of if you had $9 billion of retained earnings. That's something to be proud of if you can grow a business and have lots of profits over time. But let's see what they do with this $9 billion if they can convert it to lots of profits and lots of dividend payments for investors. Let's look at the capital structure. $9.5 billion of equity, $7 billion of debt. They're 57% equity, 43% debt. And their weighted average cost of capital, which is a blend of the cost of equity and cost of debt, is 8.1%. And that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's $22 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $20 billion. We divide that by 553 million shares. And we get a calculated stock price of $36. They're trading at $31, so they're trading at a 14% discount. It's a buy according to the model. Simply Wall Street's value is $62, so they're saying they're really undervalued. 11 analysts priced this stock, and the average price target was $36. The stock price did do well the first 2 years since it IPO'd. Then it crashed a lot during COVID, but the stock has come up well past its pre-COVID highs. The stock has done well the past 12 months. Pretty much wherever you bought it, as long as you held it for at least 2 months, you would have made money. And they pay a pretty good dividend. They raised it from 16 cents up to 33 cents. They pay a 4.25% dividend yield. They pay out 62% of their net income, 81% of their free cash flow. And their industry pays a 2.9% dividend yield, so they're better than their industry. And analysts are projecting their dividend to grow to 4.5% in the next 3 years. And their beta is a little over 1, so the stock isn't too volatile. The stock has done better than the S&P 500, up 54%. The S&P is up 36%. That's in the past 52 weeks. The 52-week low was $20, the high was $33, and the stock is trading below its 50-day but above its 200-day moving average. This is a pretty liquid stock. 2.5 million to 4 million shares are traded each day. Almost all the shares outstanding are on float. And the shorts are out after this stock. Almost 15% of the shares on float are shorted. The stock has performed a lot better than its industry and the market in the past year and past 3 years. Analysts are projecting their earnings to grow less than their industry, but projecting their revenue to grow more. And this company has done really well the past 5 years. Their annual earnings is up 56%. In the past year, it's up over 200%. If you invested $10,000 into this company when it IPO'd and reinvested the dividends, hopefully you didn't sell during the COVID crash because you would have lost money. If you're still holding on, your $10,000 would be $19,000. That's a 20% annual return. Vanguard is the biggest shareholder at 14%, then Capital Research, BlackRock, Cohen & Steers, and Wellington. They have a good PE ratio of 14.5, much better than the market median and average. Their price to sales ratio isn't too great at 12.8. They do have a good price to book ratio of 1.8. Their return on invested capital is 7%, which is good, but it's lower than its WACC of 8%. They can cover their interest payments almost 4 times. They have a good ROE at 12.5%, and they have a lot of current assets on their balance sheet relative to their current liabilities. And the company is really well capitalized. They had $900 million of free cash flow in the trailing 12 months. They have over $3 billion of working capital, and they paid out over $700 million of dividend payments, so they have almost $3.4 billion of excess funding. The best way to look at ratios to compare them to companies in the same industry. I've done videos on Empire State Realty, H&R Real Estate, and WP Carey. All 3 in the same industry as VICI. And if VICI has a number in red, they're worse than the average. If they have a number in blue, they're better than the average. When you look at a REIT, you should look at price of stock over funds from operations per share. Funds from operations is a good statistic because it strips out the depreciation on the income statement. Because PE includes depreciation. And REITs tend to have a lot of depreciation expenses, really dragging down their net income. So it makes the net income and PE ratio number a lot less relevant. Funds from operations is net income plus depreciation minus the gain on sale of real estate. So the lower the better for this number. They do have the highest ratio of the 4 companies. Earlier we were looking at their funds from operations per share, and that's been improving a lot since they IPO'd. So if they keep on this track, this number should improve over time. Their PE ratio is better than average. They do have the worst price to sales ratio. Price to sales is market cap over revenue, so they're not bringing in enough revenue to justify their market cap. That's just something to consider. So if you look at just this ratio, they do appear overvalued. Their price to book is pretty close to average. They have a really high current ratio. They have the best ROE, the lowest amount of debt. They're the biggest company on this list, and they're second highest in dividend payment. So to summarize, I have them trading at a 14% discount, but this company's future is really dependent on how much people go back to casinos in person. Because if online casinos become more and more popular, that could hurt this company because they have a lot of physical casinos and hotel rooms. But I do think it's very unlikely people will not go back to casinos. Lots of people like to go to places like Vegas, so I doubt that's going away. And our country is almost fully opened up, so that should help this company as well. But you never know what happens in the future. Maybe there's a phase 2 for coronavirus and we have to shut down again, or maybe there's a new thing that comes out. So you can't really predict the future. But so far, this company is doing the right things. They are growing. They're bringing in a lot of revenue. They're acquiring other companies. So if you're a dividend investor, this looks like a great stock to buy and hold. I ranked their free cash flow 7 out of 10, their revenue 8 out of 10, and their ratio 6 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.